You know what's weird about how rich people handle money? While everyone else chases hot tips, crypto moonshots, or the next viral stock, the people who actually end up with lasting wealth follow a plain, repeatable process. It sounds boring when you say it out loud, which is probably why most people miss it. What I found isn't a secret hedge fund trick. It's a clear, mechanical plan you can start using before your next paycheck clears. Today, I'll walk you through that plan step by step. I call it the 15, 65, and 20 rule. The numbers are percentages, and each one has a job. Stick with me, and I'll show you how to set it up, why it works, where to put the money, and how small choices multiply into big results over time. First, the rule itself. 15%, 65%, 20%. 15% of every dollar you earn gets set aside to build future wealth. 65% covers your real living needs. 20% is your fun budget, the guilt-free spending that keeps the whole plan sane. That's it. No complicated timing tricks, no exotic products, just consistent allocations that force discipline and let compound returns do the heavy lifting. Let's dig into the 15% first, because that's the engine. This slice has two jobs: protect you from being crushed by unexpected costs and put money to work so it grows over time. Both are essential. If you only use the 15% as a rainy day fund, you miss out on decades of growth. If you dump it into a risky one-off bet, you risk losing the safety you need to stay in the game. The wealthy split this purpose cleanly. Build a short-term buffer, then funnel the rest into tax-efficient, low-cost investments that compound. Why tax-efficient? Because the government quietly hands you major boosts if you use the right accounts. If your employer offers a match on a retirement plan, that match is free money. The average employer contribution lands around roughly 4.8% of pay for plans that offer contributions, and many financial advisors recommend at least saving enough to capture the full match before anything else. If your company offers a dollar-for-dollar match up to 3 or 5%, failing to contribute to get that match is a guaranteed loss. Don't leave a match on the table. If you can, max out, or at least prioritize tax-advantaged accounts next. In the U.S., that means IRAs and 401k type plans. The IRS sets contribution limits you should watch so you know how much you can shelter each year. Those limits change, but the principle stays. Use these accounts first because taxes compound against you over decades. When you let investment gains get chewed up by taxes every year, your long-term total suffers. The IRS publishes the rules and limits you should follow when planning contributions. Now, one of the most powerful forces any saver can use is compound interest. Numbers talk. So here's a clear comparison that usually surprises people. Imagine two savers who invest the same annual amount but at different times. Saver A contributes $5,000 a year for just the first 10 years of their career, starting at age 25, and then stops adding money but leaves it to grow until retirement. Saver B waits until age 35 and then contributes $5,000 every year for 30 years. Assuming a conservative 7% annual return, Saver A ends up with about $525,872 at age 65, while Saver B ends up with about $472,304 at age 65, even though Saver B put in 3 times as much money overall. The lesson is simple. Time in the market often beats the size of individual contributions. Start early when possible. That example explains why 15% matters. If you wait until you're older to save the same dollar amount, you will have to put in far more money to catch up. That's the math of compounding, and it's merciless in favor of early, consistent action. A small amount taken from each paycheck today becomes a large balance decades from now, and the faster you start, the more you benefit. Next question. Where does that 15% go in practical terms? Start by getting any employer match. Then, if you have room, fund an IRA or Roth IRA, depending on your tax situation. After you've maxed tax-advantaged vehicles available to you, the wealthy often use low-cost, broadly diversified funds to hold the rest. These are index funds or passive ETFs that track broad slices of the market. The idea is not to pick the next winning startup, it's to own a tiny piece of the entire economy. That approach historically delivers reliable long-term returns and keeps fees tiny. Fees matter. A high-fee fund that charges 1.5 to 2% annually can shave tens of thousands off your balance over decades. Small annual differences compound into large lifetime costs. Let's move to the 65%. This is your real-world budget for housing, transportation, food, utilities, insurance, and other essentials. This slice is where most people fail because expenses creep up whenever income goes up. The textbook term is lifestyle inflation. You get a raise and you feel justified to spend more. That pattern keeps people stuck. The point of capping essentials at about 65% is to protect your saving habit and to force intentional choices about where your money goes. Housing will usually be the largest single item inside that 65%. If rent or mortgage is eating the budget, choices like roommates, slightly longer commutes, or neighborhoods with lower costs can free up real cash for the 15 and 20% buckets. Be honest with yourself about which housing costs are needs and which are wants disguised as needs. Transportation is another area full of hidden leaks. In recent years, the average new car payment in the U.S. has climbed into the high hundreds of dollars per month. If you finance a new car with a $700 monthly payment, that's money leaving your pocket every month for an asset that depreciates. Choosing a reliable used car or extending the life of a current vehicle can free several $100s a month, money that compounds usefulness far better in an investment account than it ever will in a car. For context, average monthly payments for new vehicles were reported in the mid-$700 range in recent data. That kind of recurring cost makes a real difference in long-term planning. Food and daily spending are trickier because they mix needs and enjoyment. The wealthy aren't ascetics about eating. They deliberately optimize. They cook at home more often, buy intentionally, and reserve expensive meals for special occasions. That frees dollars without turning life into a deprivation program, which leads to the last piece of the plan, the 20%. This 20% is the psychological glue of the system. It's the part you use for fun, hobbies, travel, and impulse buys. You might think strict saving demands zero fun, but that's how most saving plans fail. People who deny themselves completely eventually quit and blow up their progress. Allowing a fixed, meaningful slice for enjoyment keeps the habit sustainable. Studies show that people who give themselves controlled spending flexibility are more likely to stick with long-term savings goals. That's why the 20% exists. It reduces burnout and makes financial discipline possible for decades, not months. How strict should you be with the 20%? Very. The wealthy treat it as a boundary. If it's gone for the month, they don't raid the 15%. They don't borrow against future fun. That constraint builds habits. If you feel deprived, adjust the percentages slowly, but don't let the fun budget become an excuse to splurge on what should be within essentials. Now I want to be realistic. If you're living paycheck to paycheck, the idea of setting 15% aside may feel impossible. Start smaller. If you can only do 5% this month, do it. If your essentials are 80% today, aim for 75% next month. The numbers are tools, not chains. The key is building the habit of allocating money intentionally. Once you develop that habit, the percentages become easier to increase as income grows. When your salary rises, increase the allocations so that lifestyle doesn't expand to consume new income automatically. Another practical step the wealthy use is automation. Set up your payroll or bank to move the 15% automatically to retirement and investment accounts before you see the money. Pay yourself first. Remove the temptation to spend it. Automating the flow of money forces consistency and removes monthly willpower as the gating factor. A few operational rules you should adopt immediately. Prioritize employer match, use low-cost index funds for the bulk of long-term investing, and keep an emergency cushion of 3 to 6 months of essential expenses in a liquid account. That cushion prevents you from selling investments at bad times when markets dip. Many people, shocked by a small emergency, end up on credit cards or loans that hurt long-term growth. For example, a significant fraction of younger adults have no retirement account at all, and many households can't cover a $400 surprise expense with cash. That vulnerability kills future options. Getting even a small emergency fund reduces that risk dramatically. When it comes to investment choice after you get the basics right, keep it boring. Passive index funds, broad market ETFs, and low-cost diversified bond allocations do the heavy lifting. Switching strategies based on headlines or chasing the next big thing is how investors underperform. Historically, owning a diversified set of stocks over long periods has been rewarded. If you want a number to use for planning, many advisors use a conservative real return assumption after inflation and design portfolios around that. If you prefer nominal assumptions for simple examples, long-run returns for broad U.S. equities have averaged in the high single digits to low double digits over many decades, which is why compounding is so powerful over 20 or 30 years. Fees matter. A mutual fund charging 1% versus an index fund charging 0.05% will cost you over time. Even a 0.5% difference multiplied over decades reduces final balances by a noticeable amount. Focus on expense ratios, trading costs, and advisory fees. The wealthy optimize this because the math is unforgiving. Low fees mean more of your money stays invested. Taxes matter too. A Roth-style account gives you tax-free withdrawals if your situation fits, and a traditional retirement account gives you tax deferral. Which one is better depends on expected tax rates now versus expected rates in retirement. The wealthy think about marginal tax rates and use a mix to diversify tax exposure. They also use other tax-advantaged vehicles where it makes sense, like health savings accounts or 529 plans for education, because these reduce the bite that taxes take out of compound growth. There's also a behavioral secret. Treat savings like a recurring bill. The wealthy don't view saving as a variable discretionary choice each month. They budget it as a non-negotiable expense, like rent. If it's part of the monthly flow, it becomes as automatic as paying utilities. If you treat investing as something you'll maybe do each month, you won't. A few common pitfalls to avoid. Don't raid retirement accounts for lifestyle purchases, avoid high-interest consumer debt, and don't try to time the market. When markets fall, the wealthy see opportunities to buy more at lower prices. They don't panic sell. Second, beware leverage for lifestyle. Taking loans to buy depreciating assets is a fast track to financial fragility. Third, don't over-concentrate in a single stock or speculative investment, because the upside you read about online usually comes with outsized downside risk. Now, practical numbers again. If you earn $50,000 a year, the 15-65-20 split looks like this. $7,500 to savings/investments, $32,500 for essentials, $10,000 for fun. If you earn $120,000, that becomes $18,000 to savings, $78,000 essentials, $24,000 fun. The percentages scale with income so your lifestyle can improve without blowing the system. As income rises, your dollar savings grow too, even if the percentages stay fixed. Here's a realistic timeline of how this plays out for someone starting moderate and sticking with it. Suppose you start with a $5,000 emergency cushion, then begin directing 15% into retirement and low-cost index funds, capturing any employer match. In 5 years, you'll have a mix of contributions and market growth that makes it psychologically easier to raise the savings rate. In 10 years, if you kept the habit, the compounding makes the balance meaningful. large enough that it can help you choose jobs for reasons other than immediate income or buy a home without stretching dangerously. In 20 years, you'll be in the range where investment growth is a key part of your net worth. That's the difference between financial stress and real choice. Your future self will either be quietly glad you started or quietly annoyed you waited. The math doesn't care about feelings. It rewards time, consistency, and low cost. If you stick with the 1-5-6-5-2-0 approach and adjust as your life changes, you'll be surprised how quickly you stop worrying and start having options.